Hello and welcome to a discussion on cash flows. In this session we have two questions to address. One is how different is the cash from operation from free cash flows, and what are the different ways in which free cash flows can be calculated. So let us start with the first one. The CFO, cash from operation, is a GAAP number. That means every firm is required to calculate the CFO, show the CFO in the cash flow statement. So cash flow statement shows the CFO, whereas the free cash flow is not a generally accepted GAAP number. In other words, you don't see free cash flow. Free cash flows is not visible on the financial statements. However, it is possible to calculate the CFO, the free cash flows, when from the financial statements. But free cash flows as such are not visible on the financial statements because it is not a GAAP number. Free cash flows is a cash available. It's called free because it is free from all encumbrances or all claims. That means this money is available for the investor. So therefore the free cash flows can be free cash flows for the firm, FCFF, or free cash flows for the equity, which is FCFE, free cash flows for the equity. Free cash flows for the equity is a money available for the equity holder, but whereas the free cash flows for the firm is a money available for all the investor, both debt and equity holder. Generating free cash flows. Generating free cash flow is actually an operating decision, whereas managing free cash flows is investing and financing decision. That means once I have the cash flows, the use of that free cash flow can be for paying the interest or paying the dividend or further investment in the business. There are different ways in which the free cash flows can be computed. Free cash flows we will take here. Free cash flows for the firm can be computed from CFO, can be computed from PBIT, can be computed from PAT, can be computed from NOPAT. So we will take this an example to understand how is CFO calculated. Let us go to that. So suppose this income statement is given, which shows the profit after tax, and additional information is given regarding the capital expenditure during the period, 35,000, and the additional working capital required, so therefore an outflow of 10,000. But these two information are required for finding the free cash flows. But let us first find the CFO. We know that CFO in this case will use an indirect method. The CFO is PAT. CFO is equal to PAT. CFO is PAT. Add back depreciation, that is non-cash items. Add back non-operating items. Non-operating item, that is 22,000. Then the working capital changes, which is minus 10,000. So therefore the cash from operation is 3,600. So that is a cash from operation, and we will use this number, cash from operation, to find the free cash flows for the firm. But before that, let us also find the net operating profit after tax. Net operating profit after tax is a NOPAT, is PAT, add back interest, okay, add interest, the less of tax, so therefore interest into 0.70, that is 15,400. So this interest is into 1 minus T, that is a NOPAT. Now we'll calculate the free cash flows for the firm. So free cash flows can be computed from the PAT or PBIT or NOPAT or CFO. So let us start with the PAT. So it is PAT, add back interest into 1 minus T, okay. The tax benefits of interest are adjusted, then depreciation, then capex, then you have working capital changes. So PAT is 550 on interest into 1 minus T is 0.70, then depreciation 40,000, capex minus 35,000, working capital minus 10,000, so 562,000 is the free cash flows for the firm. The free cash flows for the firm is calculated on the basis of the profit after tax and adjusted to interest because it's a free cash flows for the firm. So depreciation, non-cash, and the money investment required to maintain the more or less same level of business, and the working capital required to run the business. So we can also calculate by computing from PBIT. So PBIT is 810,000, less tax on the PBIT, so 30% of that 0.30, so 243,000. Let me make that as a negative number. So minus into 0.30, then add back depreciation, which we know that is a non-cash item, add less capex and less working capital. Capex is minus 35 and working capital is minus 10, so free cash flows for the firm is 810 minus 243, capex is minus 35, and interest working capital is minus 10, so 562,000. We can also calculate from NOPAT. The NOPAT we already calculated 567,000. So add back depreciation. So NOPAT, add back depreciation 40,000. Then capex is minus 35,000, and working capital changes minus 10,000. So 562,000 is the free cash flows for the firm. Similarly, we can also find these free cash flows for the firm from CFO. The CFO we already calculated 603,000. Add back the interest shield, okay, interest, the tax shield of interest, the tax benefits of interest, so therefore which is 30% of the tax, 30% of the interest, so 30% is into 0.30, okay. So that much of cash flows, the tax benefits will not be there. Then you have capex, and the capex is minus 35,000. We don't have to take the working capital because we have already taken that while computing CFO. We can see that here, and so CFO, while computing CFO, that has been taken, so therefore we don't have to make adjustment for working capital. Moreover, for computing from CFO, we don't have to take interest too, because interest has already been taken while computing the CFO. Similarly is the depreciation. So only the capex was not taken, but while computing CFO, we have not taken the benefits of the interest, so that we are removing here. So therefore, given an income statement, it is possible to find the free cash flows either from PAT or PBIT or no PAT as a basis. Thank you very much.